before we get started, could you guys throw in the chat where you're calling in from or where you're usually based? Do you want to see where people are joining from, and also which ones of you are Brazilian? This isn't going to be a Brazilian focused session, but oh, great. We got a lot of international, not just Brazil, which is really fun, and some familiar faces and names. Good, Pedro. Awesome. So we got a lot of Brazil. We have London. We have New York. Perfect. Bay Area, just down the street from Google. Just the exotic Bay Area for Hannah. I love that. Okay. Well, we're gonna talk to Daniel in just a second. The two events that I wanted to tell people about, which Paige or Jonathan, whoever gets there first, is next Thursday or next Thursday, June 29th. I'm doing my LA meetup. I'm bringing it to Brazil. It's called Dawn Patrol. It's really low key. It's turned out to be a fantastic format for people to kick off their day. I don't know if Brazilians will be as excited about the early morning start, but I'm going to be getting coffee anyways. So if you want to join us, please join us for Dawn Patrol. It's a completely free event, and it's going to be a great way to kickstart a day of networking. And then at night, we're throwing a little bit of a party for founders. So this one is not a free event, but it is open food and drinks. And we're going to do some fun stuff, a little bit of pitch practice and networking, but it's mostly an opportunity to spend time with me and some of my investor friends and meet each other. So if you're in Brazil, would love for you guys to join. So if you're joining, please, cameras on. We're about to get started. I want to talk a little bit about who we are so that you have context for this conversation that's coming up. I always tell people advice of all types can be valuable as long as you know the context with which the person giving the advice is coming from. And so for me, if you haven't met me before or heard about my background, I ran the new media product group at a tech company called MLB.com, a digital media company for Major League Baseball. I was a venture capitalist at Graycroft. I was then a co-founder and CEO of a small startup called Tape. We raised a couple $1 million and had a small exit in 2020. And ever since then, I shifted over to this line of work because I wanted to see how much of it I could solve. So I was first Silicon Valley Bank's internal fundraising coach before leaving to do this on my own at my company, Adamant. Our focus is making fundraising easier and more accessible to as many founders around the world as possible. You might have heard of my podcast and the other stuff that I do. So that's the background on me. And I will ask Daniel to give a little bit about himself, but I did want to tell you all that I find Daniel to be one of the clearest thinkers that I've met. He's a friend of mine. I'm honored to say he's a friend, and we've done work together in the past. But he has such an interesting background. He was a concert oboist that studied at Oberlin before doing the exact opposite, which is going into finance. He was at the big PE shop, Warburg Pincus, before starting his company, Pitsy, which is a large insurance company in Brazil, raised over $30 million from top investors. It's still running, still a great company. But he is now an investor at WTI, which gives him a lot of perspective from all sides, all angles, different formats. And so this is just a really valuable opportunity for you all. And if you didn't know, WTI is the leading venture debt provider, which is another form of capital that you might raise sometime in the future. So that's my quick introduction to both me and Daniel, but I did want to spotlight Daniel real quick and talk a little bit about, well, where are you, Daniel? So people know, where in the world are you?
I'm in Los Angeles, California.
Not as exotic as Sao Paulo, but probably better weather.
Very good weather right now.
I know I gave my little spiel on who you were, but I wonder if you could maybe add a little bit more texture, because we do have so many people that are international, a lot of people that are in Brazil. So can you give a little bit of color, especially around the part of you deciding to start a company and moving to Brazil? and then tell us a little bit about what that 10 years was like. You can do the summary highlights of it first, and then we'll jump into a couple questions that I have for you.
Sure. Yeah. It's great to be here. It's been a wild ride over these last 15 years or so, but I was in New York at Warburg Pincus before making the jump to Brazil. And at Warburg, my focus was financial institutions investing. So it's a very large fund looking at complex businesses like insurance and bank type companies. And around 2010, they started thinking about opening an office in Brazil. And that's really where my idea was sparked of moving to Brazil. But they asked me to develop theses for if you were to invest in Brazil around that time, if you recall, when Brazil was on the cover of The Economist, and we had the World Cup and the Olympics coming up. Kind of what were the things that you would be looking at? And so I started digging into Brazil and got very excited about all the things that I saw. Mainly, it's a massive market, which is something that's not really understood outside of Brazil by most Americans. And it's a market that is not well understood generally because it's very protected both by language and culture and regulation and taxes and all sorts of things. So most people didn't really look at it. So everywhere I looked, when I started looking at numbers, it was just really compelling and exciting. So I had no idea what I was going to do, but I decided that I wanted to move to Brazil because it seemed like a really interesting challenge, starting a business in a place where I didn't speak the language, nor did I understand the culture and didn't really know anyone. Thought it was going to be kind of a 2-year, kind of my liberal arts version, an MBA is kind of how I describe it. So take the money I could have spent going to places like HBS or others, throw that into the experience of going down to Brazil as a single guy, where I could learn Portuguese, meet some interesting ladies, have some experiences, learn as much as I could, taught myself to code. And it had the upside of, if things went well, it could build to something bigger. Pitsy was what that ended up becoming. And so over the last 10 years, I focused on scaling an insurtech before that was a word, and focused a little bit, or in the early days, on the realization that smartphones in Brazil were just starting to be adopted, but they were insanely expensive. But they were as important to consumers there as they have become everywhere in the world. But in Brazil, it's fairly easy to get robbed. If you break a phone, it's not easy to get it fixed in most places across the country. And so started working on the problem of how do we help protect people and their phones. In the early days, this was not intended to be a venture business. I didn't raise capital.
I didn't know that.
Yeah, it's never really expecting for this to be, a scaled business. I really wanted to go down and try to build something that could just be sustainable. I wanted to learn how to operate a business because I had been doing investing. And when you're investing, it's really easy to have a growth model where you just kind of move the growth rate from 20% to 30% in Excel. And I just didn't really know what went into actually doing that in real life, or how do you pay the bills while you do it. Happened into venture, not by doing a fundraise process or doing a lot of the things that we're probably going to talk about here, but really because as a founder, I was constantly looking to learn, and I was by myself. I didn't have a co-founder. I didn't have really a team in the early days, and so I got forwarded an email in the early days by someone that Jason knows well, from HBS. It was an email from a partner at a firm called Flybridge. And he said he was going to be on Harvard's campus. He was looking for Brazilians at Harvard Business School that after HBS would be interested in going and starting a business in Brazil, so he could give them capital. And I wrote to him and I said, well, I'm not Brazilian, I'm not at HBS, but I am in Brazil starting a business, and I love talking to smart people. So when you're down here, I'd love to chop it up a little bit and talk about what I'm up to. And I found in the conversations that I had with him that I really benefited from having just smart people around me that could challenge my thinking, because he was just a really interesting pattern recognition type guy who could tell me what were really dumb things I was doing when I was just kind of trapped in my own vacuum of my mind. And eventually, over the course of 6 months of just having these great conversations, he was like, don't you want some money so you can like, grow faster or try more things? And eventually I asked him what that would look like, and he gave me a term sheet, and that's how I kind of got up and running.
Was that Jeff Busking?
No, this was John Carlin. So this was Jeff's partner. Yeah.
Got it. Okay. I wanted to add in a little color and texture. We're always trying to get what our guests say and try to generalize it, or try to pull out the things that I think founders need to hear. And if you'll notice with Daniel's first round of capital, he wasn't like going after venture capitalists to raise from them. So the feeling was, from that VC's point of view, at least the way I read it, was like, oh my God, this guy like doesn't need money. He could build the business on his own. And even as a VC who was interested in this one entrepreneur, it took 6 months of relationship building for something to come to a head. And then finally, like, the guy wanted to make a move and try to convince Daniel to raise money. And so you'll see a lot of that happen in some of the best fundraisers, where either the positioning of the raise, the way the process is run, or the conversation and words used. But we're always trying to make sure that it's not Daniel being like, could you give me money? Like, I'm in Brazil, I need money. It was actually the VC who was like, I see this opportunity, I see this talented person, maybe I can catch him early and invest. And that looks like that's what happened. But that wasn't the last round of capital you raised, right? That was a very, very small amount relative to the amount that you ended up raising over how many rounds?
4 rounds.
4 rounds of capital, and very different market conditions, right? Like, especially for Brazil.
Yes. Yeah, for sure.
Can you just touch on that? So the first money was put in 2011, 2012?
2012. Yeah, early 2012. Flybridge and Kazakh co-led a seed round.
Yeah, which is funny, because that's right around the first time I ever went to Brazil. And I remember Brazil at the time being just the most expensive country that I'd ever seen. Like, I'll tell you about, I can tell you about the things that I compared to, but it happened to be a New Year's party. We went down for a New Year's party, as you do in Brazil. And I just was like, how on earth is this party this expensive? But the market didn't stay there, right? So tell us a little bit about what it's like. I think this is where I want to transition and talk a little bit about, because we have such an international crowd. Some are from Brazil, but others are in Europe. What has it been like raising money from a sort of international country outside of the US, targeting US investors? I mean, you could take this in a lot of different directions. But yeah, I would love to hear your thoughts around that.
Yeah, I think in most markets, if you're in the US, you have to think a little bit about how your story resonates with the zeitgeist of the moment. So right now, if you're building an AI business, you're in the middle of a really interesting time to raise money. But if you're in any other space, largely, you're not in a very interesting capital market cycle. And that's really just kind of sector is how I think about it. When you're outside of the US, or you're in places that don't have as many homegrown investors that just deeply understand the market, and I would put Brazil, particularly when I went down to Brazil, squarely in that. These days, you've got more, homegrown funds that are starting to pop up, but you've got this overlay of, in addition to sector interest or not, you've got geographic interest or not. And so these days you do have, a couple of folks who are always investing in Brazil. You've got Kazakh, you've got Monashees, you've got, a variety of folks now, even at different stages. At the time, you didn't. And so a lot of actually the work I did in raising money, I raised from folks who did not have significant either interest or presence in Brazil. And so as a result, it tended to be a very different kind of way of selling. It was creating other forms of credibility with these investors. So getting intros that were kind of in the vein of, I know you don't do Brazil, but if you were going to do one thing in Brazil, this is the thing I would do. And
Mm,
having someone who's credible say that. And I had a little bit of the benefit of, the pitch I would give people is, this is a guy from Warburg Pincus, which is a very highly credible brand, who went down to Brazil because the Assurian business model, which is a case study in global success for many investors, he's building that in Brazil, and he speaks English, and he talks in the way investors understand, and he's credible for a number of reasons. And so it was very easy to get early introductions from folks who hadn't invested in Brazil. And so I had
mm.
to think a lot about that. And so go
On
ahead.
on that topic, because you're talking about you're comparing when you raised versus today, where there are a lot more investors that are actually investing solely in Brazil or 90% in Brazil. But on the topic, let's talk about what that would mean today for a Brazilian founder or a Spanish founder or a founder in the UK trying to raise from the United States, which by and large is the most respected venture capital ecosystem in the world. And so that alongside, the cost of capital, the prestige and the sort of networks that come with it, it is a market that a lot of people would like to raise money from. Do you think it's all that different, in terms of what the bar or what founders need to do in order to attract capital from the United States to invest in their home countries?
So I think there are different tools that exist now or are easier to leverage. So as an example, one of the questions, if I was an investor from the States thinking about investing in in an economy that I didn't dominate, I would be thinking, one, like, how do I get comfort in that market?
Yes.
In the early days, there just weren't that many kind of like check the box, this is an investor who understands the market, who's participating signals. I benefited in that Flybridge brought in Kazakh, and that made that easier in the future rounds that I was able to raise. But these days, you've got a couple of those that if you have Kazakh, if you have Canary, if you have whatever, like there's certain versions of that on your cap table that people can use as a signal. And so that helps. I think investors like to really avoid things like adverse selection. And so there's this question of why is this person coming to me? Like, why am I getting this deal access? Is it because other people who know the space better than me don't have conviction?
Yeah.
And so figuring out how to solve that, I think, is an important tool. So in my case, when I went to investors in the States, I would have a reason for why I wanted to bring them in, that there was something specific that they brought to the table that normally they wouldn't. Like I've got enough other people that were interested in putting in money. I wasn't looking for money. I was looking for smart people that could help. So when I raised from Thrive, as an example, Thrive is a very consumer focused. Well, now they're everything, but at the time they were, investors in Warby Parker and investors in just like a lot of great brands that had brought empathy to traditionally commoditized industries. And that was what I was trying to do in the insurance space. I was trying to do a direct to consumer, really human approach of how do you sell insurance. And so I built a relationship with them and asked for help for intros to people in their portfolio around that theme. And so it was very organic when I wanted to bring them in. It wasn't like, this is our first deal that we'll ever lead in Brazil. Like, why is he coming to us? It was like, oh, like we've been adding value. He enjoys that. If we find something that resonates from a term sheet perspective, that makes sense.
Yeah. Yeah. That makes a lot of sense. I did want to insert one thing. We have like about 50 people watching this from different social media platforms. And so for the people that are not in the Zoom call with us, if you'd like to interact one-on-one or ask questions, go into my feed and actually register and get the Zoom link and just join us here. I did want to pull out a couple of things from what you just said, which I thought was spot on and also fascinating to see, because this is important for people to know whether or not you're raising from an international country in a weird business or enterprise SaaS in San Francisco. At the end of the day, when a VC, any investor, any professional investor is trying to invest, they're investing early before the numbers say with certainty that it's going to be gigantic a lot of the time. And so they are looking for that level of comfort that Daniel talked about, right? So your job is to figure out what you can do to bring that comfort to the investor so they feel comfortable enough to make an exciting investment. And that can be done in a lot of different ways. Daniel's already talked about a few of the things that he did, right? Building a relationship for 6 months is one. Having the right introduction that brought him into the conversation initially, which was like this person, Daniel was able to borrow credibility from the person that is making the introduction so that when he starts talking to an investor the first time, there is this level of like, ooh, I have some comfort with him. Fast forward to today, what Daniel didn't have as much access to is a bunch of pre-seed or early stage investors in Brazil, where if he were able to get those people to invest first, as he would go to different markets in the United States and say like, hey, there is a reason, like Daniel said, that we are looking for capital from the United States. It's not because we're desperate for capital. It's because we think you will be very, very valuable. They get a chance to look at the signals on their cap table, on Daniel's cap table, or whoever's raising capital, and be like, there is a check mark there, right? There's something that says there's a level of credibility and a reason that I should continue talking. And so I think more important for internationals that are trying to go down this path, but for everyone, this is the path of fundraising across the board. It's building comfort with an investor. It's establishing credibility, because these VCs, these investors, need to make a decision based on limited data. And what we're going to be looking to do in any sort of motion is fill the gaps of data with signal, with social relationships, with other things that bring that comfort that we're looking for. So I think the last couple of questions I'll ask before, I really just want to let people riff with you and ask more pointed questions, is whenever I have an investor come, I love asking them to describe, like, what are the things that they look for? What are the things that maybe light them up or catch their eye? I know you're doing this with WTI on the venture debt side of things, and that is applicable, but I wonder if I could switch the question a little bit more. And I want to ask about your time just getting into the game, especially from a fundraising point of view, and say, what do you think some of the biggest mistakes that you made, or the things that you didn't realize were so important within fundraising that you've only developed after 4 or 5 rounds of raising capital? And maybe it's some of the things that you articulated really well now and kind of sort of like 2020 hindsight. But I think describing some of those pitfalls that some of these younger or less experienced founders might fall into could be very helpful.
Yeah, sure. Oh man, so many mistakes, so many things to learn from. So I think, so I'd probably put them in 2 buckets. So the first kind of biggest mistake, I didn't really understand the power of just kind of the virtuous cycles that exist in venture or life. So when, for example, Flybridge and Kazakh came in and did our seed, I just thought of it as having $1 million in the bank and having some like smart people that could help me. I didn't fully grasp that Flybridge has a unique network in that they are, one of the dominant kind of like Harvard and Boston ecosystem early stage investors. A lot of experience in like different types of experiences or different types of sectors and like muscles that different companies in their portfolio had. And similarly, I mean, at the time, Kazakh was not anything close to what it's become. But I didn't have a sense for what the brand of Kazakh could eventually bring to the table. I just kind of thought of them all as capital and help providers. And similarly, when we ended up raising our next round, so after that seed, Thrive came in and did our Series A. which was $2.5 million, which I guess now is like a pre-seed round or whatever. And so obviously times have changed, but I didn't fully grasp how impactful the Thrive brand would be for almost every downstream decision that we had. It made fundraising in the future easier. It made recruiting easier. It made closing partnerships and PR easier. And so a lot of these decisions can be made in different ways, and obviously depends on how many options you have of who you raised from. But I've mostly made the choice to just work with great funds that could end up being, they could build concentric circles that just add on top of each other. And that's worked really well. And I didn't grasp that in the early days. It was kind of just, I ended up raising money from people that I liked. And so I would lean into that. I think choosing valuation over partnership is probably usually not the right answer, but that varies. All of it comes down to the options you have. So creating optionality is a really important one. If you don't have any options, you're going to take whatever capital is going to get you to the next stage. But if you can constantly be creating options, you'll be able to improve your situation. And so that the realization that there's always like more moves or more actions that you can perform that will increase the optionality is really interesting. So as an example, so my first two rounds did not really follow the traditional playbook of going out, running a process, raising money. My third round did, when we raised 15 million bucks. That was a process that followed a little bit more of the kind of calendar density approach, and brought in all our existing investors, figured out and mapped who did they know, and made sure that we had 2.5 weeks of meetings and a tight process, and everything was organized. And the result of that was we got a variety of term sheets, but none of them were quite what we wanted. And then really it was, once we had the term sheets, how did we kind of like read what were the options that we could construct based upon the levels of interest we had from different people and the signals that we were getting and the signals we could be sending off. So we moved from term sheets led by people who were maybe like not our ideal leads at lower valuations than we would like. I had a lead that I actually wanted, but they didn't want to put in all of the money for the round. This was Valiant, which is actually a hedge fund, but just the partner who wanted to participate was just a brilliant Brazilian randomly, that happened to be in the Bay Area, and had added so much value that I just really wanted him to be the one representing the funds going forward. But he didn't want to do 15 million bucks. It was both too small for his fund size, because his fund was a $2 billion fund, and too large for them to just do personally. They wanted to do 5 of 15, and that's not very, it's not a traditional lead. They had gone to investment committee with terms that were significantly better than the other terms I had gotten. They ended up not getting through investment committee for size reasons. So they, it was just too small a check for them to focus and be distracted by. And so I ended up turning that signal of interest from these folks, constructed a party round where they actually led in the terms that they were going to lead with at investment committee, but they led with a $5 million check, which allowed me to bring in a bunch of other smaller investors that I really wanted to bring in, versus just the folks who were going to give me, the full amount, but were, not the investors I really wanted. So I think there are a lot of just kind of like moves, and kind of like you can be creative around fundraising.
So the two main things you just talked about is like, one, the first thing you talked about is the unexpected, these aren't your words, but the unexpected value of venture capital networks, venture capital that venture capital and professional investors bring to the table. And then the importance of optionality, and wanted to say a couple words to both. So I'll actually take the importance of choosing venture capitalists first, and how you can hear this advice, which is because they're related, right? You can hear this advice where people are like, VCs are like, you want to choose the best partner and choose the perfect investor that knows your industry. And what I tell founders all the time is, we want to have that luxury of being able to pick. In order to get to the luxury of being able to pick, you do have to run a process. You do have to create optionality. And the other thing that I'll address, because you'll hear the other side, especially on Twitter, and it's, people just bashing venture capitalists for good reason. They're easy targets. But a lot of people would like to say like VCs just like are, sucking the value out of the system, or not value at all. That's just dollars. And look, I think there is a limit to how much a venture capitalist or professional investor can do. There's a limit to what they can actually influence in terms of the success of the company. But there are some really important things that venture capitalists do bring. And I was part of a couple big exits at my last firm, Graycroft, and time again, we looked at it, or other people outside of the firm would talk about it, and they're like, this company doesn't sell for $1 billion if they don't have Graycroft on their cap table, or this company doesn't get to this thing if they don't have this investor on the cap table. And it's true, because a lot of the big outcomes that you'll see are that aren't IPOs, especially, are like threading a needle, right? Like, it's, if you're getting acquired as you're growing, it's so relationship driven to make sure that like they actually do a deal, that the social connectivity that a venture capitalist network brings to the table can have such large influence. And then Daniel talked a lot about the follow-on effects of having this positive network and brand that allowed him to do a lot of other things.
There's also, there's a counterintuitive set of skills that are required to unlock that value. And that was something I didn't really understand. And I see other founders, they have great brands and like, interesting investors on their cap table, but they are just constantly frustrated that they're not getting any value out of that. They're having board meetings that are really annoying, and they're getting pressure. And I actually just had a really joyous experience with my investors over time, but I had to learn, how do you ask for help? How do you provide context so that they understand where they can add value? How do you create kind of rapport over time? How do you build relationships? Like, there are a lot of skills to really unlock that, of knowing kind of like who to go to when you have what kind of problem,
right?
Accessing the portfolio so that you're not just, so you're asking them to connect you with people who are experts on a particular thing, not expecting an investor to solve everything for you. So there's a lot of learnings around those things.
Yeah, totally. So in the second half of this, I'd like to let founders ask any questions that they want, especially of you, and reminding them of how much you've gone through in terms of raising capital, running a business, being a gringo down in Brazil, running a venture debt portfolio, anything around there. So I'm kind of stalling for you all in case you have questions, but would love to look at hands being raised. And we'll prioritize the people that will talk to us live. So I know Taryn, and please turn on your cameras if you're going to ask questions so we can talk to you. Taryn, if you're there, and will talk to us live.
Yeah.
Start with you. Hey, Taryn, first, can you tell us where in the world you are?
Yeah, I'm based in British Columbia.
Amazing. BC. Beautiful. Can you ask the question that you sent through chat?
For sure. So we're looking to raise a pre-seed round, and we're not like 100% confident we want to build a company that'll be worth $1 billion or $10 billion. Should we hesitate to raise like a few $100,000 from VCs if we don't know that we want to pursue that kind of eventual like valuation?
Yeah, I have a very specific tactical response to this, but Daniel, I don't know if I want to make sure the guest of honor has his say. So I'd love to hear from you too.
Yeah, well, so I think that the kind of capital you raise is going to influence future decisions. And so you do, like, it's important to reflect on it. I think there are businesses that don't need to get to $10 billion that still make sense in venture capital. Usually it comes down to what valuation is going to make the math work for their fund. And so I think different folks have different approaches on that. But I definitely felt in building a business that once I raised venture capital, it was very difficult to stop raising venture capital. because you get a lot of subtle pressures in different ways. And when you have money, you feel the inclination to spend it. And it's tough to kind of wean yourself off of that. And typically that only goes one direction unless you're really intentional and thoughtful about how do you eventually wean yourself off of venture. So yeah, I do think it's something that I would think about. But I do think in the pre-seed stage, there are probably ways that you can still make that math work as long as you're driving to profitability as soon as possible and really intentional.
Can you just elaborate on that? Like, what does the valuation need to look like?
Well, I think Jason's got a lot of good content on this. But basically, funds have certain math for how their returns work. And so if you're raising a certain amount of money at a certain valuation, the fund's expecting a certain probability that your result is going to get to an amount that's going to return the value of the fund. And they all have different kind of like ways that they think about this, and there's different shortcuts that each folk use. But at the earliest stage, they're probably assuming that maybe 1 in 100 of their companies are going to actually be one of these breakout successes. And they try to estimate if it's a breakout success and you really only have, 1 out of 100 as an example, that are going to be breakouts, how big does that have to be for the valuation that you're raising at? So they have different maths, and it depends on the sector. So hardware businesses and software businesses think about these things differently. So there's a lot of intricacies to it, but it's a math question of how much do they need to expect to be able to make on a probability adjusted basis.
Yeah, and Taryn, I'll double click on that for you a little bit, because part of your question was very specifically, I don't know if I want to build a $1 billion business or a $10 billion company. And the math that Daniel is talking about is the return expectation that they have in order to make such an early stage bet. And for sort of simple math, usually people say at your stage, at pre-seed, they have to believe that there is the potential that they could make 100x on their money, 100 times what they put in. And so there are two numbers in that math problem that you can mess around with in order to get the answer to be 100 times. One is that you exit for $100 trillion, in which case the math is pretty simple. Whatever valuation you're at, 100 trillion divided by 100, is a big, big, big multiple. But the other way that math works is to say, maybe you don't want to be a $1 billion business. Maybe you want to be $100 million business, or maybe you think that that's a potential, a few $100 million. And the other way to get there is that your valuation now is actually lower, right? Like, so if you raise money at a $2 million valuation, then if you exited at $200 million, that would, simple math, without taking into account dilution, be 100x. So that's two ways to think about. And then the other two things I'd say for you and everyone else is like, there is, when you're talking about a few $100,000, that is a tranche of capital that you can go raise capital from angels. And it's probably more likely that that amount of capital would be the type of investment that an angel would do. And an angel, like the word angel comes from Broadway, actually, like these financiers that would back shows, and they were angels because Broadway shows don't really make a lot of money. And so their intent was to support the arts and support the creators with that money. And a lot of times angels, of course, want to make money, but they're not in their heads being like, well, if they're not professional angels, they're not like looking at the portfolio and are like, well, I need to underwrite Taryn's company needs to be 100x. And I don't know if her outcome is going to be. A lot of it can be just, look, we love this founder, we love her mission. We think we could make some money off of it. And that's one way to get to a few $100,000 of capital. And one broad statement I'll make for everyone is there's a challenge for a lot of founders, which is there's this style of business that needs money to start, or would be way easier to do the early stages of a business with a little bit of outside capital, and could build a really good company, but not a gigantic company. And that's that weird middle stage that I think a lot of founders get frustrated with, because they're like, I know I'm building a great business. I just need a little bit of money, and it doesn't fit venture math. So went off on a little tangent there, but hopefully that makes sense or helps you with the idea of where to raise capital.
Yeah, that helps a lot and definitely resonates.
Okay, awesome. Let's go with Pedro next. Hey, Pedro, how are you, man?
Hey, doing good. Thanks. Thanks for being here, Daniel. Really appreciate it.
My pleasure.
So, questions. One is, if you could elaborate a little bit more on that piece of advice that you shared regarding you wanting to have extracted more value out of your VC's portfolio. Did you mean that in the sense of contacting other startups that they've invested in to partner with them, or like what was it?
Yeah, sure. So it almost was never commercial. It was never trying to form partnerships, so that occasionally can happen. I guess the way I think about it is, I guess we, like, every company that we start is unique in some way, in that we're like, solving a problem that's never really been solved before, in the same way that every human is unique. But we also have very predictable life cycle events and things that we all deal with over our life. Companies have a number of muscles that have to be built. And every company has most of these things in common. Like, how do you find product market fit? How do you scale an engineering organization? How do you deal with people who are just not performing well? How do you build a brand? Like, a lot of these things, they're just commonalities in lots of other businesses. And usually in my venture investors' portfolios, any particular problem that I was wrestling with, there was someone who was just great at that had figured it out before. So as an example, like Warby Parker, like these glasses, Warby Parker, they had built a really humanized brand around something that traditionally was seen as more like a luxury item. And they built this like really interesting way of communicating and customer experience and design. And they were things that as I was thinking in the early days, I wanted to build my customer experience organization for insurance, which is not traditionally a very like human-centric type industry. I wanted to figure out how they did that, how they thought about it, who they hired, how they structured their KPIs, like what were the things that made them able to build what they built. And so Thrive, having been an investor in them, put me in touch with the two founders, and the two founders got me in the room with Mada, their first employee, who was their head of customer experience, who also randomly happens to be Brazilian. And I ended up developing a really close relationship with her, and she became a mentor for my head of customer experience. And all of that was just because I knew a problem that I wanted to solve. I could try to figure out who in my investor group likely had someone that was going to be high value in that problem. And I asked them to make that connection, and then followed up and built the relationship.
It's like a huge network of mentors, basically.
Yeah, exactly. And in Brazil, actually, Endeavor actually solves some of this in Brazil, because they try to have mentors that are very experienced in certain things that can help future founders. But yeah, mentor groups, that's how I think about it.
Gotcha, thanks. And I'm cheating a little bit here, but what was your strategy for setting and negotiating valuation? Or did you have to? Like, did you just agree already with what they provided?
No, there's always negotiation. So the best advice that I got in the early days was actually from the Venture Hacks blog, which I think still exists and provides a lot of advice. But basically, especially 10 years ago, and this is starting to evolve, but it was the realization that valuation for many venture investors is more of an output than an input, because no one knows what companies are worth. And so really, it actually was the product of two important other inputs. One is, how much of the company does an investor want to own? And it's, it was basically always a target of something like 15 to 30% in each round. And they had targets over kind of like multiple rounds where they wanted to get. But usually at every round, in the early days, you would give up like 20% dilution. And so that was kind of like the benchmark. You knew you were going to give up somewhere between 15 and 30%, and how well you were able to negotiate or articulate your point of view, and how much competition you had. dictated how much you were going to give up. And there are lots of like intricacies to that of like, how big of an option pool do you have to allocate to future employees, and where does that come from? Like there's venture hacks in particular educated me a lot on some of those important value drivers. And then the second piece is how much capital are you raising? Because if you know I'm raising $5 million and I'm giving up 20% of my company, that tells you what your valuation is. That's how the math works. And so you know roughly what the dilution target is. If you can articulate a case for raising more capital without taking more dilution, that effectively ups your valuation. And so a lot of it was like saying, this is the amount of money I think the business needs to get to the next milestones. This is how big it will eventually be, roughly. And based on that, this is how much of the company that I am I'm comfortable taking dilution. So there's a lot of playing those levers. That was kind of one piece with individual investors. And then it was playing the competitive dynamics of, I love you, I love the deal, but you're giving me half the valuation of what someone else is, which means I would take double the dilution. That's too big a gap. Help me close it. It's playing the competitive dynamics and figuring out how to kind of like bring people together in the right way to maximize value. Those are probably the two biggest levers.
Great, thanks a lot.
Yeah, it's funny, Daniel, the funny subtlety that a lot of founders don't understand, and honestly, I barely understand now, having been in and out of VC firms, is like the ownership targets are just targets. Like a lot of people come into that being like, when a VC goes, well, we got to own 15%. If you like really think about it, it's like, well, what's stopping it from being 14%, And shouldn't it be cash on cash returns, So I guess like the point for everyone here is that a VC will somewhat by design come in there and be like, well, this is how we do things, and this is the thing, and we need this. And the reality is it's all a conversation, right? As long as they're able to put enough money to work, and what's enough for them. Like if you're creating competitive dynamics, if you're pulling on the emotional strings, that things that they care about, there is almost always an opportunity to move things. So yeah, when Daniel started by it, there's always negotiation. It's totally true. And the one other thing I'll say about asking for help and value out of a VC firm, it's hard to say which direction, if it's causal or what came first, but some of the best investments that I've seen, personal angel-wise or from a fund structure, what you notice is that the founders are really good at asking for help, like are really good at tapping into their cap table and their investors to do both big and small things. So it's definitely a skill that I think all of you should start cultivating. I think we have time for these last two questions. Dimitri, how are you, man? Where in the world are you?
Great. I'm in San Jose, California.
Oh, very good.
And my first question is it okay to ask a question that has nothing to do with Brazil, just a venture?
Oh, of course.
Okay, good. Just wanted to confirm this. So here's my question. So fundraising, it's all about the numbers. It's all about how they all adapt. Now, this really depends on the business model, right? There is B2B, there is B2C. There is a lot written about them. What about B2B2C? So could you give any specific advice for a B2B2C type of businesses? And I can make it more specific. What we have, I believe, is the first meaningful application of a B2B2C approach to the real estate brokerage.
So you're just asking for broad advice for B2B2C.
Correct. Yeah, and what specifically this means, right? How do you see VCs tend to evaluate B2B2C businesses? Is there anything specific about their metrics? Because let's say if this is just B2B, let's say it's an enterprise software company or SaaS, right? We count the customers, we count the addressable market, the price point. It's very simple, right? If it's B2C, we count the consumers, we count monetization per consumer. B2B2C, it's a little bit more complicated as a business model. It has a lot of additional opportunities. It kind of brings the best of both in certain regards. But on the other hand, it's more complicated. So the real question is, how do you explain the B2B2C models to VCs? Are there specific ones you target? Anyways, just wanted to see if you might want to give advice on B2B2C models.
I mean, I'll say something pretty broad first to start with. The different models of how you go to market and attract your customers, like it is relatively, I mean, it is important. And certainly if you're going on a three-sided, B2B2C marketplace, there are more complexities. But for me, I think it's not so much about the model and about the problem that you're solving. So like you may be going down a path of thinking that the complexity of your model is the reason that VCs aren't getting excited. And I think what is more likely, without knowing, if you're having problems, is that VCs aren't getting excited by the problem space first. And so that's my one broad statement for any startups. And then the second thing I'd say for any marketplace business, and this you're talking about a three-sided or a B2B2C almost, being able to communicate how you get one leg of the stool on board first is really important, right? Because like if you communicate in a normal marketplace or even B2B2C, if you're like, yeah, at scale, when everyone is playing, when all three sides are all invested, it's going to be amazing. Like, sure, that's one of the things that makes those types of business so powerful. But your ability to describe what you do in the early innings and what you're going to be executing on in order to build momentum towards those other things, I think is super important. Yeah, that would be my first couple comments. I don't know if Daniel has anything, but.
Yeah, well, so Pitsy is B2B2C. And so fundamentally the business that we scaled was partnering with retailers who sell cell phones to sell our insurance products for us, right? And so we raised money successfully with B2B2C models. None of the investors that we went to were like B2B2C focused investors or something. I don't think there's too many that are specific go-to-market specialists, at least that we encountered. The metrics that we had to use for proof points at different stages of the business were different. And you just have some metric which is about how are you building the channel, and then how productive is the channel. Those are kind of like the two dimensions that we had to look at. And then we got slightly different questions than probably others did about how sticky is the channel going to be, what the competitive dynamic looks like there. How do we manage for the fact that we don't have direct interaction with the end customer? So we can't as deeply control the experience. So there were some questions around those things, but really, yeah, I think it came down to what Jason said. It's, we had to tell a compelling narrative and story that got people excited about the need for people to protect their phones. I don't think people were as focused on, how we were going to sell it, as long as it solved the problem. I was the right person to do it. We had compelling metrics that showed it was working. The unit economics made sense in the context of B2B2C. Sometimes that becomes a challenge. And then ultimately it's like, how sticky is the channel and can it scale? How big can it be? We weren't a marketplace though. So we didn't have a marketplace dynamic. So we didn't have the kind of chicken or egg problem that Jason was articulating. It was just kind of scaling channels.
Got it. Awesome. I forgot that Pitsy was B2B2C.
If I may, a little follow-up. Here's another thing that I hope you could comment on B2B2C. So B2B and B2C tend to have very different cultures in terms of how the companies are built, what investors are looking for. So I'm just curious, anecdotally, do you see B2B2C closer to B2B or B2C, or it really depends on the company? Because consumer investor and investors in the business solutions tend to look for very different things. And here they kind of have to fuse. Any thoughts on how to make those things fuse?
Yeah, I think you need to figure out who your core customer is. If your core customer is the end customer or the channel, I think that'll dictate a lot of your cultural decisions and the skills that you have to build, what you prioritize.
Awesome. Thanks for the question, Dimitri. I think we can squeeze one more in and then we'll say bye. Artem, can you do your question really quick? First, say where you are.
Yeah, sure. Hi, everyone. I'm in London.
Oh, very good.
First of all, thank you for this, and thank you for your story. Really impressive journey you're having, Daniel. As far as I understand, you started your company with now this notion of raising capital and growing fast from the very beginning. For early stages, pre-seed, would you say starting with this initial cash flow, and then after this cash flow was built and steady, start raising capital? And how solid this cash flow should be in terms of revenue, or both fundraising and making initial revenue are equally important for an early stage startup and should go in parallel?
I don't think there's any one size fits all advice to that question. Sadly, I know you're looking for an answer, but I think different people have different alternatives and have different goals of what they're trying to drive for in the business. I was very fortunate in that when I started my business, I wasn't trying to build a fast growing business. I also didn't need cash. I was in a lucky position in that I kind of mentally allocated a certain amount of money to go to business school. And so instead of paying that in tuition and room and board, I paid that to support myself to go slowly and kind of like learn hard things as I was building in Brazil. And so I made decisions that were unique to me that I don't think most people do. So as an example, when I first moved to Brazil, I took the first couple months, didn't focus at all on, coming up with a business idea, went and lived on an island and just focused on learning Portuguese. Because I knew that was going to be essential if I wanted to build a business in Brazil. I had to take the time and prioritize it. So I had a foundation on which to build. And similarly, most people in tech businesses hire engineers. I wanted to learn to code. And so I took a year to learn Ruby. Ruby on Rails was the hot language at the time, and started learning that so I could get the site up on my own. So I wasn't prioritizing speed and I wasn't prioritizing cash flow. I was prioritizing kind of like fun and learning and development and kind of taking my time. And I realized that most people don't have that luxury or are in very different situations. So I think it depends on what your goal is. You can raise a bunch of money and build towards something big and have binary outcomes, or you can do it kind of slow and methodically, raise money when it makes sense, but possibly do most of it without taking much dilution. Depends on the size of the business, depends on your goals, and depends on the options you have, I think.
Yeah. I think if you can run a business where you don't need outside capital, you'll find that outside capital wants to invest in you even more. And so like the most powerful thing a VC can hear is no. Truly. Like, so the best piece of advice, and I'd say like this is colored by my own experiences and the businesses that I've run, but like if you can go build and operate your company in a manner that is like, I'm going to do this with or without them, and then build relationships with VCs so they understand that there is this guy Artem building a really cool thing in London. The situation that you're trying to drive towards is one where you have the choice on whether or not you want to raise money, and that like the heat around you to raise the money is so overwhelming that you're like, you know what, I'm going to go do this. And then the fundraise process ends up naturally occurring. That practically is not how 90% of fundraisers happen, right? Like people are like, fuck, I need to go raise capital. How am I going to do it? And then like try to run everything together. But the way you asked your question, Artem, made it seem like you have that choice of how you want to like operate the next 6-12 months of your business. And if you have that choice, if I had that choice, I would try to run my business as best as I can, grow it as fast as I can, or, with the capital that I have available, either my own capital or through customer capital revenue. And then along the way, I would try to build awareness and create relationships with VCs so that I don't have to raise money. But if I did want to raise money, I'd be put in the best possible situation to do so. Okay. That'll be it for today's office hours. Daniel, I wanted to say thank you. I like the haircut. It's good flow. Gives you a little bit of room to grow a little bit longer for the next few months. And just remind everyone, if you happen to be in Brazil next week, I get there on Monday and we'll be trying to spend time in the community. So we'll share links with in an email afterwards. And I did want to say Daniel is, again, he's a venture partner at WTI, one of the leading providers of venture debt in the world, and just an awesome guy. So keep an eye out for what he does. Definitely worth a follow. All right, everyone.
Thanks,
Thanks,
guys.
Daniel.
Thanks. Bye.